From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. A fresh round of trade uncertainty hits markets as Trump accuses China of violating the deal with the U.S. Fresh economic data show U.S. consumers hitting the brakes on spending and imports plummeting. And U.S. Treasuries on track to deliver their first monthly loss this year. We begin with the big issue, economic and trade uncertainty.
Just really hard to read the data right now.
Our assumptions are that inflation kind of remains elevated over the short term.
That really negative consumer sentiment that's out there is driven by inflation.
Consumer is still resilient, but again, it is at less robust levels than what we've seen over the past couple of years.
In the second half of the year, we do think inflation will probably go higher even in the U.S.
Once you see economic data start to move around, that tends to drive bond markets more than supply.
The negativity around the bond market is starting to get to a place where you got to take the other side of it.
10 and 30-year part of the curve are risk assets. I don't want to be the one to stand in front of the steamroller right now.
Tariff levels that we had yesterday are probably going to be the tariff levels that we have tomorrow.
These will have an effect on inflation. These will have an effect on growth.
The tariff impact has not yet fed through the economy.
It just extends the uncertainty.
Many companies are on pause. They're waiting to see what's going to happen.
The bulk of the Fed will be moving toward the reality of let's just wait and see.
And we start with a look at those consumer spending data out today. And as you can see, still positive in April, the month when we had those China tariffs onslaught launched. You also see that it was a big decrease from March. Now, perhaps consumers were pulling forward their spending a little bit and then they were reining it in a little bit in April. Will be interesting to see in May exactly what happens. So if you flip up this board and show you what imports did, well, you can definitely see a massive reaction here, down almost 20% in April, basically just shutting down imports for the month of April. Perhaps it's important when this data was collected, when the survey data happened. We see that particularly when it comes to consumer confidence, because we actually did get a little bump up in consumer confidence in the final UMISH reading, showing that with less uncertainty, perhaps consumers are getting just that tiny little bit less concerned about tariff impacts. But it's all a bit of a mishmash, and we're going to dive into it all with our guests. Meanwhile, earlier this week, Minneapolis Fed President Neil Kashkari said the Fed is in a holding pattern with all of this economic uncertainty.
There's no question that the shock of tariffs are stagflationary. Is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says. Our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
Joining us now, Lindsay Rosner. She's head of multi-sector fixed income investing at Goldman Sachs Asset Management. And with us here in studio, Collin Martin, fixed income strategist at Charles Schwab. Lindsay, let me start with you. What do you make of the economic picture right now when we're getting some benign data, including the PCE data today, and then some data that might be signaling a little weakness?
Yeah, so I think when it comes to the data, the Fed said it best, wait and see mode. We don't have data right now that is conclusive in terms of there's been a lot of changes as to the end state of tariffs over the past 6 weeks. So all of those data points incorporate a different amount of time of that 6 weeks with different kind of facts at the baseline. So what we're seeing now is a bit of information, depending on the day, that can be read more positively, more negatively. For us, we need to see more data. I think what is crystal clear, though, is that the impacts of tariffs cause uncertainty, make consumers consume less on the margin, and it will be impactful to the negative side, to growth. It's just a question of how much.
And when, Collin, we certainly see particularly shorter end yields moving every time we get an economic data point these days. But is the economic data really telling us much yet? As Lindsay said, we do have to wait a little while, perhaps.
Yeah, I'm in full agreement. We need to wait a little bit. We have a lot of the soft data that is concerning. And there's a lot of discussion about what's going to happen down the road if and when the Fed's mandates are in conflict. That's the key thing we're talking about right now. But what matters right now is they're not in conflict. Inflation, it's still sticky, but we got some good news this month with both the CPI and the PCE. But at the end of the day, it's still above target. And the concerns about the labor market and what it might mean for growth, they're not here yet. So right now, the Fed can afford to be patient, and we'll have to see how all this works out. Uncertainty is still here in terms of the actual hard data. I think it's going to take a few months before we actually start to see how this flows through. I mean, if we just look at the inflation report for April, I think the question is, did they pass along some of those tariffs, or did they not put them in effect because they actually didn't pay them, or they got the goods in before the tariffs went into effect? And are they still kind of waiting to see how it all plays out? But unfortunately, uncertainty is still here. Even though it's an on again, off again, I don't think that gives consumers or businesses much confidence to make big plans for the future.
Exactly, and we heard that in many of the earnings reports as well. Well, I want to point out that Goldman Sachs this week, we spoke with John Waldron, and he said this concerning the GOP's tax bill fueling some fear in Treasuries. Quote, while all the attention was on tariffs, I think the attention rightly is shifting certainly in the bond market to the US budget deficit and the fiscal picture, which I would characterize as somewhat concerning. Now, on the other hand, White House trade advisor Peter Navarro is saying he thinks fears are overblown. Have a listen.
A lot of the hysteria around the big, beautiful tax bill centers on the Congressional Budget Office scoring that bill in a way which says there's going to be a $3.7 trillion addition to America's national debt. If you do the math properly and you look at the history of the CBO forecast, you actually see about a $5 trillion swing to a $2 trillion surplus from the bill.
Lindsay, I'm not sure a 30-year bondholder would necessarily characterize themselves as being hysterical. Even last week when we were at 517 or so, would you?
No, I don't think the move to 517 was one that was could be typified as hysterical. I think it is absolutely responding to the facts that were at hand and what we saw in terms of what was in the House bill. Now, as we all know, that is not set in stone. That is not the final. There will be negotiations going forward. But what the market's grappling with is the U.S. fiscal house going to be in a better place? And what we saw in the House bill so far pointed to, one, that there was more spending, and certainly more spending than was expectations.
So given that, Collin, what do you do about this Treasury curve? Are we to anticipate that the 30-year will rise again, for example? We're back down to 4.92, which seems perfectly calm given what we had seen in the last few weeks. But at the same time, less support in auctions for the longer end, more support for the belly in particular.
Yeah, we do worry that long-term yields can rise a little bit from here. So the main guidance we're providing our clients is to focus on intermediate-term maturities, the belly of the curve, because we think that protects against reinvestment risk if things do slow down and the Fed needs to cut more than expected, or if we get that increase in long-term yields. We do think yields can move up a little bit higher from here, but it's not to a hysteria type level. Maybe on the 10-year, for example, we get to 5% or so. Historically, we haven't really seen a relationship between debt deficits and what that means for Treasury yields, but we think that can change to a degree. I mean, it looks like deficits are here to stay for a while. It looks like they'll need to be financed with debt in an environment where we have interest rates at elevated levels relative to where we've seen over the past handful of years. That means interest expense, takes out more and more of the budget. So we need to find potential buyers. Not that we think there aren't enough buyers where we're going to see yields surge to 6, 7, 8%, but we think 5% is a possibility right now, given all those concerns out there, and given that we do see the possibility of deficits staying here.
Lindsay, if we do go back above 5%, particularly on the long end, I mean, is that anything to be concerned about? At what point do we need to be concerned about foreign buyers maybe perhaps moving away at the margin?
Yeah, so maybe take that in two parts. The first one, what happens if we're above 5%? I think we eventually reach a point on those back-end yields where the hedge efficacy and also the carry starts to be attractive. Is it 5? Is it 5.25? I think we can debate what level that is, but at some point in time, that is a long-term asset that will be attractive. The second part of your question is, should we be concerned about foreign investors not being interested in our market again? And I think a lot of this centers around the discussion or the response to the downgrade of the U.S. to AA. There are very few, literally close to 11 big AAA countries out there. But if you look at the size of their bond market, it pales in comparison to the size of the U.S. Treasury market. In fact, the U.S. Treasury market from a daily transaction perspective, trades roughly as much as the total size of each of those markets every single day. So when it comes down to it, the U.S. market just has this depth and breadth that other markets don't have. And again, the rule of law is something that is really strong, really robust, and is really important. And I think that will continue to encourage investors to seek out U.S. assets, particularly Treasuries.
Sure. I mean, that's always the case until sentiment really changes, right, Lindsay? And it wouldn't take too much of a change for there to be sort of a large ramification in the bond market. Collin, I do want to ask you if you're getting questions about the potential change in the treatment of foreign holders of U.S. assets, the so-called revenge clause. Is that becoming a thing yet, or are we going to have to wait and see if it really impacts appetite?
You know, I think it's too early to say if there's staying power there, but we are getting a lot of questions from clients about just the international ramifications of everything that's going on right now. I think a lot of investors domestically, they hear about the dollar and they hear about the fluctuations we've seen and the potential loss of demand for treasuries, but I'm not sure they fully grasp, how that relates to them. At the end of the day, we don't think it matters much for them. We haven't changed our view on the safety of treasuries. I agree with everything Lindsay said about where are the other alternatives for foreign investors or even domestic investors to diversify away from the dollar or U.S. Treasury. So our idea of the perceived safety hasn't changed. I think that we could see the dollar decline a little bit from here going forward. We're not expecting it to lose its status as a reserve currency, but it could lose a little bit from here for any number of reasons. But I think one we're seeing a lot lately is just the idea that the tariffs in and of themselves, the trade policy, are a bit adversarial, and you could see some foreign investors step away a little bit, but not to a degree that we're worried just yet.
All right. Our thanks to both of you. That is Collin Martin from Charles Schwab and Lindsay Rosner from Goldman Sachs Asset Management. Up next, the auction block. High-yield bond issuance tops $31 billion for the month, the most since September. We're looking at credit next. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where we look at the main highlights in issuance this week. We start in Japan, where an auction of 40-year debt met the weakest demand since July. The average bid-to-cover ratio for the $3.5 billion deal was 2.21. This result adding even more pressure on the government to reduce issuance. Here in the US, for Treasury sales, investors snapped up debt for 3 straight days with strong demand. The 5-year sale saw indirect bidders take down a record 78.4% of issuance. The results helping to lower concern, perhaps, that a widespread sell America sentiment will take hold. And looking at high grade, AT&T leading the way this week with the biggest sale. It saw an order book of more than $22 billion worth. This month's $153 billion in overall sales is the highest for the month of May since 2020. And speaking of credit, we caught up with PIMCO's global head of credit research to get his take on the health of the market.
Where there is more concern is lower down in the capital structure, particularly those below investment grade companies that have borrowed in floating rate liabilities, so bank loans in the bank loan market and also the private credit market, where you do have a lot of companies that pay floating rate debt and rates are much higher than people had expected today and will be much higher than people had expected over the course of this year. And so the weight of those interest costs is pretty serious on what are already pretty levered companies in the context of an uncertain economic outlook.
We're joined now on set by Meghan Robson, head of U.S. credit strategy at BNP Paribas, and Dominque Toublan, who is head of U.S. credit strategy at Barclays. Thank you so much. So, Meghan, let's start with you. Credit spreads have fallen a little since April, but is that warranted? Is that risk premium not necessary anymore?
We think a lot of the good news is already in the price. So we've seen a pretty sharp rally since some of the good news on tariff delays in April. But going forward, we think there's going to be a few headwinds. One is positioning. So investors were underweight the market and have since added risk into some of the tariff negotiation news. So that tailwind will be going away. And then the second is data. So we've been operating in this sort of data vacuum, if you will, where we haven't really seen the full impact of tariffs in the economic data. So going forward, we think those two factors will be more of a headwind to credit spreads, and we're forecasting wider spreads into the summer.
Yeah. Dominque, this Japan concern, how prolonged could it be? Are we over it already, perhaps?
So actually, I was in Asia last week, so I talked to them directly, and it depends which place of the market you're looking at. For the corporate bond market, it's very hard to replace the US dollar market. It's much bigger than the rest of the world. They tend to look at higher quality, particularly for those like life insurance companies looking at the long end. Look, the US high-grade market, 10-year plus, is 10 times larger than the European IG market, 10-year plus. It's very, very hard to move away from the US dollar. So they are thinking about it, exploring it, but bottom line, it's very hard to execute given the depth, the breadth, and liquidity that we have in our market.
So we saw, quite a substantial amount of turmoil because of the Japanese market last week. I mean, does the Bank of Japan or the Treasury have to decide to lower issuance in order to make this bond market, this global bond market, just a little bit more settled?
That's the risk we have in front of us, right? If the long end yield, the real yield in particular, pops up too much, you start to have a situation where financing conditions are effectively tightening and growth is not fantastic. That's the combination that credit spreads don't like, because there's no saving grace for companies if they don't have growth or don't have financing easily available.
And we were combing through earnings calls and just listening for anything. But perhaps one of the signals that we got was from Sonali Basak, who was interviewing Christina, Minnis and Vivek Bantwal at the Goldman Sachs Leveraged Finance and Credit Conference this week on private credit. And I just thought one of the, well, everything was interesting, but one of the things that Christina said was that companies may have to be more nimble. Let's just have a listen to the exact quote.
The cost of capital is higher, which puts a bit of a governor on the amount of debt. So the quantum of debt's a little bit lower. It's about a turn lower than it used to be. And so I think companies just have to be much more nimble and very thoughtful about how they manage their businesses, whether it's their CapEx plans or working capital. And yes, probably not taking that last quarter half turn of leverage and thinking through putting a little bit more equity in.
So if companies, be they public or private, are not taking that last quarter turn, that last half turn of leverage, what does it mean for the overall market and for people who are trying to, pick out some great opportunities, Meghan?
I think that she's speaking very well to the lingering uncertainty. So, there was this relief on tariffs, and now this week with the IEEPA ruling, it comes back that maybe the tariff trajectory is less certain than expected. Companies are operating in a very uncertain environment, which is the bottom line. I think things like CapEx, the path of CapEx will be delayed. So if you're making a CapEx decisions, you're a CEO, you might delay those decisions until you have more clarity around the policy path going forward. And if you look at the earnings results first quarter, we actually saw CapEx move lower already into negative growth territory, which sort of speaks to this is already underway.
And so, Dominque, how are you handling those lines of defense? I mean, are you going on the defensive, or is there going to be a time soon where you can maybe start to poke your head out a little bit again? Or are you just waiting for the Fed to do something?
I think the technicals in corporate credit are really too strong. The yields are attractive. 5.25% in high grades, 7.5% in high yield is good. And the supply is actually very low. Just give you a number in investment grade. In the last 3 months, 400 billion issued. But if you net that of maturities and coupons, which tend to be reinvested, you had zero. So really, the technicals remain strong, and we think keep us tight for a little bit here.
Okay, so what areas of the market are you looking at for maybe a potential first look at some point in the near future? And will you have to wait until the Fed decides to do something about rates?
If you have to wait for the Fed, might have to wait for too long. Investors are getting money in. They have to invest it. It's yield seeking, so there's no really alternative for them. They have to deploy that money. So where we tend to look at, as Meghan was saying earlier, we rallied quite a bit, but some parts of the markets have lagged. They tend to have lagged for good reason, like cyclicals, like triple Cs. But then I think it's the time to talk to our sector analysts and pick your spots in these places.
Yeah. Meghan, are we in for a more traumatic ride over the next few months? The MOVE index has gotten very complacent. Perhaps complacent is not the right word. Perhaps we're, waiting for the next round of turmoil. But it does appear like it mightn't be over.
So we do think that a wider spread range is reasonable to expect. We're not expecting a large spike in volatility. And so I think one place that we like going is in the intermediate part of the investment grade curve. So some of the discussion earlier about the Bank of Japan, I think investors are very reticent to put risk in the long end. If fiscal deficit conversations come up, you could see that sell off. Alternatively, if we see growth slow, you could see a rally in the long end. So we sort of like hiding out in more the intermediate part of credit.
Intermediate part of credit and treasuries too. It feels like everybody is hiding out just, the 2 to 5 to 7 year space, right? All right, I'd like to thank both of you for your insights today. That is Meghan Robson with BNP Paribas and Dominique Toublan with Barclays. Still ahead, the final spread, a busy week ahead, a rate decision from the ECB and new US trade data. Well, they should provide updated insights into how the world is processing uncertainty. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, and it's a big week coming up. We begin with Chair Jerome Powell. He has remarks on Monday. And of course, the Senate returns to Washington facing a GOP-led tax bill. Tuesday, we get US vehicle sales and more Fed speak, this time from Austin Goolsbee and Lori Logan. Plus, of course, earnings season not complete. We have Dollar General out. Then Wednesday, more Fed speak. This time, Raphael Bostic and Lisa Cook. Also, we get US ADP employment data, the beginning of a round of employment data, which should give us some kind of read on the labour market and whether it's weakening or holding in there. Thursday, the ECB will make its rate decision, followed by remarks from Christine Lagarde. We'll also be getting new US trade data. Plus, Victoria's Secret, Lululemon and Broadcom will report earnings. A couple of big ones then on Thursday. And of course, it's all eyes on Friday and the US May jobs report coming out. And so let's take a closer look at that jobs report for my final thought. Of course, we are expecting it to be a little bit weaker in terms of the overall number of non-farm payrolls, coming down, at least in terms of estimates, to 130,000. But that's still a pretty good, pretty decent, robust labour market potentially, particularly if the unemployment rate stays around 4.2% and average hourly earnings month over month increase. That would be a good sign, though year over year, the estimate is for them to decrease. But all of that coming Friday morning at 8:30. The next big catalyst potentially for the bond market. This has been Bloomberg Real Yield on Bloomberg.